I will not go into the details of the nature of the recommendations on greater capital and loss-absorbing debt requirements. You mentioned the costs and benefits. We did our own analysis, and you mentioned some of the figures. The government has done some independent analysis in the months since we reported, and in fact they have come out with lower cost figures than we ourselves did, a slightly lower range of costs. Now, you know, £1 billion, £2 billion is of course a huge amount of money, but the economic and possibly beyond economic value of a gain of banking stability will never be perfect. You cannot rule out absolutely the risk of crisis, but anything to reduce the probability and in particular to reduce the impact should there be a future crisis, the economic gain of that is enormous. And when you think, you know, we should have had 4 years growth from 2007, we still have not even got back to the level of output then. Unemployment is 1 million greater. The fiscal position is you know, in really tough shape, hence the austerity programs. Reducing the probability and the scale of impact of those risks is very well worth paying a cost in those terms. We do not believe that our measures are threatening to UK competitiveness. They do impose costs on the affected banks by removing and curtailing the implicit taxpayer subsidy, but that should not be there anyway, and none of the banks in their submissions to us argued in favour of a continuation of an implicit taxpayer guarantee. But apart from that, this does not damage the ability of British banks to compete internationally. We look carefully at regulatory arbitrage risks included within Europe. We do not believe, where we've pitched our recommendations, that those are serious risks. And we indeed think that a more stable basis for UK banking should be good for UK competitiveness, including of the financial services sector. We also believe that the ring-fence design creates a good channel for converting deposits and other bank funding through to lending to the real economy in the UK. Timetables you mentioned. The Basel process for higher capital requirements, we're going beyond that. The Basel process sets the start of 2019. So we set that as our recommended final date. Our package is quite radical in all its elements, added together. And we express the hope that government and parliament would legislate within this parliament, in other words, by May 2015, so within the next 3 years. And some elements of the reform can come in well ahead of 2019. Some do not require legislation, in particular the competition reforms. They can happen, we recommend, in the next 2 years. Others do take more time. And as well as the Basel date of 2019, the other reason we recommended a 7-year total time span is because the current fragility of the recovery. If you require much higher capital requirements within 1 year, that could jeopardize lending in the current fragile economic situation, whereas spread over 6-7 years, it should not be problematic in those ways. I will leave the competition recommendations for discussion if people wish to, but should stress that financial stability reforms successfully deal with the too big to fail problem, then a bonus of that is it helps with competition issues, because if the big banks are perceived as having taxpayer support and their smaller rivals not, then the competitive playing field is tilted unfairly in favour of the big banks. So there is a competitive level playing field bonus if you are successful in dealing with the financial stability problem. To conclude, in the summer, in the weeks before we published our final report, when the Eurozone problems were becoming much more clearly acute, some voices in the UK were saying, now is the worst time for bank reform. I think it's too fragile. It's maybe interesting in theory, but it must be put off. It's absolutely the wrong policy to go forward with now. We absolutely rejected that idea. The Eurozone problems are many things, but among them is a two-way interaction between the banking balance sheet and the banking problems and the macroeconomic shock from problems that affected the financial system through to the fiscal position. And while there is a perception that governments remain exposed to the balance sheet risks of their banks, you then have a feedback between the bank balance sheet and the sovereign balance sheet. There are some very interesting charts on risk spreads, how the CDS spreads on bank debt and those on sovereign debts have, since the crisis started, been in some ways moving quite closely together. And if you get the taxpayer off the hook, that will help sovereign debt spreads go down, so there is a big gain potentially in public finance costs. And the counterpart of that is the risk is more with the providers of finance to the banks, but that's how an economic system should work. So our soundbite was, do not let the too big to fail problem be transformed into a too delicate to reform problem. You should deal with the current macroeconomic stress by having a reasonably generous timeline, which our 6-7 year timeline aims to do. But there needs to be credibility that the reform package is being advanced. And the government response, the formal response was just before Christmas, was a really pretty full implementation of the reform package we proposed. The government, and this is perfectly reasonable, is going to consult on some elements. Which kind of depositor preference, the greater loss absorbing debt, what geographic scope of bank balance sheet does that apply to? Should there be a de minimis exception for very small banks? These are perfectly reasonable implementation questions, but the broad thrust on financial stability and on the competition recommendations is very much in line with our recommendations. I went to we're here in the Senate, I went to the House of Commons in Parliament when the Chancellor made his statement, and there was about an hour's debate. The opposition spoke, and the three main parties are all very much behind this, two in the coalition and the Labour opposition. Their main proposal was that I should be kept in existence, the Commission should be kept in existence to keep a running commentary on whether the government is implementing our proposals. I'm not sure, well, the Commission does not exist no more. I don't think there's any need for this running commentary because there's a lot of transparency about this process. It's of huge interest to the press, including the very serious press like the Financial Times. So the spotlight, I'm sure, will remain on this. Of course, it's not the end of the story in the UK. There will be legislation before Parliament and then the regulatory rulemaking and then implementation. Much can happen in a 6-7 year period, but there are also very important international things happening too. Brussels, Basel, many aspects of bank reform and related financial reform, shadow banking, market infrastructure, remuneration issues, and so on. Very important, I think, is global resolution. Can we get to better global understandings on how, if a future crisis happens, you can resolve some of these huge entities? We think ring fencing will help that, loss absorbing debt, higher capital requirements will all help that, but there is a very big international agenda too, and our remit was, of course, just for one country. Thank you.